India, some are at 3 years, just to put things on a relative scale, okay? In China, we might see them at 33 months, okay? So there's a lot of variation in terms of how long it rears. And then furthermore, how many of them are you rearing? How many heifers are you carrying to maintain your adult herd? Do we have too many, too few? Okay? And then, of course, they enter the milking string, and so we see first lactation going to, we typically see about a 3,000 pound difference from first to second. And so that's a driver of reproductive efficiency in the first lactation animals. We want to get them to those higher level, higher curves earlier. All right? And the typical cow in the Northeast might go through 2.9 lactations, and then she's culled. And so we want to manage these curves by feeding these animals so that these lactation curves all shift upward. And we do that by, one, maximizing the dry matter intake into those animals. And indirectly, we do that by improvement in forage quality, because of course that allows us to feed that animal greater volumes of feed. So very, very important. And then of course we have to make a decision of how long should that animal stay in the herd. How long do you keep a cow? Do you let her just make the decision based on her biology breaking down? She has a health event that's catastrophic or lame or doesn't get pregnant. All right, maybe a certain set of cows, that's how you make the decision on them. But others, it might be that, gee, this animal isn't as economically lucrative as a replacement animal. Well, you're not going to get that information by looking at the cow per se, but by looking at the records and by looking at an algorithm that's going to look at, hey, a replacement heifer is a better decision right now than keeping this cow and further investing in her. All right, and there are some of the data record systems allow you to make those decisions. Okay, and so that's what I mean by the emergence of business intelligence. So this allows us then to make sure that we're always maintaining, quote, the right cows on the herd. All right, and so looking at what the culling decisions are. All right, what you realize that all of this requires very active management. In other words, the dairy, the cow, many people look at it as what we call an option valued asset. In other words, the value of that animal is very much a function of who's managing it. All right, and so you have some control over that in terms of determining what that value of the animal is. All right, so it requires active management, all right, to cultivate. Now this is a process that we use. It's called a tornado graph, and I think Joe will show you some of these. What I'm showing you here is the annual profit per cow per year on the x-axis. And then up here we have varied inputs, inputs into that profit function. In other words, okay, milk price, milk yield, culling percent, all of these are parameters that we typically see on herds. And what we do is we vary them over a range, okay? And sometimes we'll use a standard deviation to define the range. Sometimes we'll use a min and a max. And what this shows is then the impact that this is a change in that parameter is going to have on the annual profit per cow per year. So looking at this tornado graph, what do you see as what are the two big drivers? What are the big drivers? What are going to be very influential? What? One, milk price, right? You guys live and breathe that, right? Okay, what's your opportunity to really have any impact on your milk price? Well, through maybe quality points, through components, right? Okay, that'll be very impact. And then right after that, you have yield. Okay, now you notice that yield is a little less than the range of milk price, because to get that yield, what do you have to do? You have to make an investment in feed, right? And so they're not going to be identical. And then everything else kind of becomes small potatoes. All right, so the big drivers are yield, and then we have culling, we have the marginal cost of production, lactation, debt, a whole host of other things. So we like to do this tornado analysis to find out what is this decision, what's really sensitive, what's a real big driver. All right, and so anything that's going to impact these dimensions is going to be very impactful on the overall dairy at large. Okay. All right, how do I grow economically what every dairy thinks? Okay, well, certainly you multiply your price times your volume of milk minus your cost, and that gives you a rough idea of your profits, right? And I think everyone's kind of, yeah, that's pretty basic. Okay, but what controls price? Well, a lot of market forces beyond our control are going to influence price, but we do have the option of milk quality. We can lock in some of the milk prices to reduce some of the risk. Okay, so there's some risk mitigation strategies that people can deal with to kind of influence the price. But then we have to deal also with the cost side. All right, and I like to split cost into two areas. One of where we call cost efficiency. So this is where you look at what inputs am I buying onto my herd and how do I buy the most efficient. So if I have soybean meal from mill A and soybean meal from mill B, I'm going to look at who's giving me the best price per ton for the same 48%, whatever. Okay, so that's cost efficiency. Then the other element is how much of that cost or how much of that input do you use? And this is where you have to be careful, because you don't want to control costs by decreasing your input use, all right, because that'll have a negative impact on your volume. And that's the whole concept of marginality. So when you hear that term marginality, what people are talking about isn't cost efficiency, but how much of that input should I use to get the most bang, the greatest return, okay? And so there's a subtle difference. We certainly don't want to pursue any strategies that reduce input cost if they negatively affect volume, okay? So distinguish between when you're looking at a situation of price efficiency or cost efficiency versus use efficiency. And then of course volume. Well, volume we have a lot of control over. We can add more cows to the herd. We can do that by either buying them outright or growing them, right? So we can grow into a larger herd. And so those are going to be the dimensions in which you can expand the herd. And I think the new added caveat is this whole emergence of the ability to genomically test animals, even at the embryo stage, that are going to start to make it where it's not just selecting any old cow, but the right cow. And of course, on the other side of this, we have the yield per animal. And what are the drivers of that? And of course, the fundamental driver is ultimately pushing feed through that animal. And we do that either directly by changing the shape of the lactation curve. So by feeding that animal better, managing her in that early postpartum phase, or we do it indirectly through reproduction, in that we make sure that she's in the milking string when her lactation and dry matter intake curves are maximal. Okay, and so it's indirect. So those are the two dimensions in which you're going to impact yield when you think about it. All right, and of course we like to look at all of these decisions based on using the principles of marginal analysis. Where marginal analysis is where we want to look at what that incremental revenue, that incremental change is, okay, on the positive side, versus what's the incremental cost change. And we only want to pursue a decision where the marginal return is greater than the marginal cost. And it's very easy to say this, somewhat more difficult to implement, okay? But that's the fundamental underlying economic principle that we want to use, or the criteria that we use to drive our decision making, is this concept of marginal analysis. So let's step back and look at the dairy business in terms of the investment in assets. So you invest in stalls, you invest in milking parlors, you invest in cows, and we typically will see an asset range of $6,000 to $15,000 per cow. All right, that includes the land. So this is if we were to go to the herd and let's sell everything. This is roughly the value I would get per animal. So you can think of it as you have this money sitting there on your farm in these various categories, and of course you want a decent return on that. You want a rate of return on those assets that is competitive with maybe you doing something else. All right, and so we want to make decisions that really enhance that rate of return on our assets. So all of the elements that go into influencing that. All right, and so this is just showing over time what's happened. This is some data from the Northeast, and you can see that the portion of equity has been growing. Part of that might be the changes in land value. You can see there's always been about a $2,000 debt per cow. All right, so the total of that is your assets per cow. And so you want to generate maximal revenue from these assets. All right, so we want to make sure that we don't have what I call imbalances in our assets. In other words, when you look at dairies, they're always in various stages of growth. They might have a parlor, a 6x6 parlor, or the size of the manure pit might be able to contain 80 cows, and yet they want to go to 100. So there's always this imbalance. The land mass might support 120, but my parlor will only support 100. And so when you have these imbalances, what it happens is that you have excess asset capacity in some of them that isn't generating money, isn't generating returns. And so what you want to do is make sure that you don't have any excess in assets, and you want to make decisions where you're trying to always make sure that balance is at what we call the sweet spot. When you think about it, forage yields, crop yields, one of your biggest assets, of course, in dairying is your land mass per animal. How many acres does it cost for you to maintain a cow unit on your herd? All right, and of course, if you have higher yields per acre, all right, you can support a larger cow mass. And so that indirectly will affect your rate of returns on assets, okay, as you indirectly increase the yields in your cropping. So important to look at, make sure we have a good asset balance. And so then we like to look at the metric, the asset turnover ratio. So we want to look at what are the amount of sales, what are the sales that you're making per dollar of asset. So I have all these assets, okay, cows, facility, how much sales is being generated, all right? And so we like to see that north of 45 cents per dollar. So in other words, I like to see, in terms of milk sales and cow revenue sales, more than 45 cents per dollar of asset value, okay? If we get below that, we're wondering, gee, do we have a lot of asset imbalance, or are we, maybe we need to be thinking about a different allocation of our assets, okay? So very, very critical, and here's some trends that we have been observed over the time period. So when we look at kind of the dairy operation, you have kind of the whole asset pool, okay? And so this is all your facilities and land. And then we have the ownership of it. So in other words, how much debt and how much equity do you have in this operation? What's the partition of these assets, all right? And of course, what we'd like to do over time is where we want to grow, where we own more of those assets. We want to grow the equity portion of those assets, all right? And so we do that by making decisions, all right? Well, first of all, we can look at this on our balance sheet in terms of what's the total assets, what's our liabilities and debt, plus our equity is going to equal your total assets, all right? But we want to manage those in a manner, all right, that maximizes the rate of return on investments in those assets. So what are all the decisions that we make? What breeding system to have, what forage, what crop to grow, how much do we feed? Basically, we're giving inputs to this pool of assets, and what we want to do then is have a return on that, get net returns that can help pay down or offset our debt and expand our whole asset pool. So this is wealth creation, okay? All right, and so we want to make decisions where, yeah, we make investments in opportunities, but we want to make sure that the returns on those investments are greater than their cost, and then we use that to help grow the equity portion of our dairy operation. And so we really want to make sure that we have a good decision-making process to make sure we select lucrative investments. And of course, we can look at this at an aggregate sense over on an annual basis, looking at the profit loss statement. Okay, so how are our revenues relative to our costs against this pool of assets? And from this, we want to generate sufficient funds to pay down debt, but also to grow equity. So in other words, there are two elements. There are two elements that have to come out of every decision that we make. So every decision has to be sufficiently enough of a return to pay off the debt, all right, and also to grow equity. And we call this the hurdle rate, all right, the hurdle for a dairy. So in other words, what is the rate of return? What's the minimal level of return needed to grow economically, all right? And this will vary from herd to herd depending on what's your partition of how much debt and how much asset you have, all right? But anything that is below that hurdle rate isn't going to accumulate wealth on your herd, okay? And we have analytics that help calculate what that is. So there's this grow above debt and to pay off debt and also to grow your equity. All right, so if we look at the rate of return calculation, we see in the denominator we have our equity and our liabilities, okay? All right, so that's our total assets right there. And then in the, so this is your facilities, how well your asset fit is, do you have any inconsistencies there? And your goal is, of course, you want to ultimately minimize this per pound of milk. And then on the numerator side, we have what's coming from the revenues, okay? So we have a sale of milk and components and cull cows and calves, and if we in cropping, that'll be part of our revenue, okay? And then, of course, we have to look at what are the costs, and of course, a big one is feed cost. Now we have feed costs that is, we have fixed costs that are relative to labor, replacement, facilities, veterinary care, and feed for maintenance. So all of these are fixed as a function of the number of cows we have in the herd. And then we have the component that's variable. And the variable cost are all those costs that are associated with making more milk. All right, and it's important to distinguish between fixed and variable. All right, so the minute we're looking at variable costs, we can start to look at what are the marginal changes that are occurring in those costs, okay? So it's important to tease out fixed versus variable in any decision that we make on the dairy. So if we look at this whole idea of wealth creation, there's what we call the efficiency of operations. In other words, high dry matter intake, low feed costs, the high yield in both our crops and animals, high repro efficiency. So all of these are kind of the technical aspects of that make an operation efficient. And then we have to look at what are the, and we can look at what's our income, what's the net income over total revenue. In other words, how much am I netting as a function of my total revenue? And use that as an index of the efficiency of my operation. All right. I can look at the efficiency of asset use, as we described before, in terms of what's my milk sales per unit of asset. And so this is going to be a function of what's my land mass per animal, the percent free stalls. So when I have empty stalls in a barn, I'm having more asset value tied up with no milk production. All right, I can look at parlor use efficiency, okay? So all of these are how am I managing the use of my assets? Am I generating maximal sales per dollar of asset, okay? And then the third element is looking at what's your tolerance to risk. In other words, how much debt do you want to incur relative to what your equity is? All right, so this is a function of what is our assets per cow and what component of those assets do we actually own, or what we refer to as our equity per cow. All right, and so if we look at these, we can come up with a system of where if we look at the return on equity, we can take these three elements, efficiency of operation, efficiency of asset use, and our risk tolerance, and if we multiply all those together, all right, we end up with our return on equity. So right away here you see the whole the dairy operation from, okay, what are the elements that improve the efficiency of operations? So this is where you're consulting with your nutritionist, your crop specialist, your repro veterinarian, what have you. How do I generate maximum net income as a portion of my total revenues? And then how well am I using my assets? So what are my total revenues that I'm generating unit of asset? And then what is my position in terms of my ratio of assets to equity? In other words, how much do I want to have in debt versus how much do I want to own? And when you multiply those three things together, you get a return on equity. This procedure is actually developed by the DuPont industry to evaluate their position. So here's the industry using this as a metric and a method to evaluate their growth, and yet we can use it on the dairy. And so operating efficiency, you focus on the cows, the people, very tactical. Asset use efficiency is really the facilities. It's more long-term. And then, of course, your financial leverage, focus on assets to ownership. What's your risk tolerance? And those three factors will determine your return on equity, okay? And so what we have some analytics, and so this is one of the first that I'll show you. These are all available. I'll have a slide that shows the website. If you want to get into our web page, you can access all of these dashboards at our website. So this allows you to put in and look at what happens when you drive a calculation on equity per thing. So if I pull on the calculator here, I can see that, gee, as I change the milk yield per I'm going to influence what percent of profit sales, and therefore then influence my rate of return on equity, okay? If I look at the asset, what kinds of sales am I generating based on my the amount of assets I have, I can vary those parameters, and ultimately this will then influence what is my rate of return on equity. And of course, you want to see that maximized. So that's the fundamental basics of those parameters.